Hall. This month's town hall is the election and impact on tax law. And we thought it would be timely because of the fact that we're approaching the end of the year, the holiday season. Many people are looking at their charitable giving, the new tax laws that have been in place for this year, and then the possible changes that are going to be taking place with a new administration. In a few minutes, we'll begin our program. We have two panelists today. One is Howard Lappin. He will be giving the overview of the presentation, and the second is Christine Post Duncan. Both of these individuals are experts on estate planning, accounting, and the law of as it relates to tax on individuals' estates. The Journey Care Foundation has been doing this town hall for about 8 months now. This started because we didn't want to have a gap in the ability to educate and partner with our corporate partners, community members, and philanthropists. So today's topic is what we have developed because of impact or because of comments and questions you, our donors and partners, have been asking us. So once again, Howard Lappin and Christine Post Duncan will be joining us in about 30 seconds. What I want to do now is, one, let you know that this is being videotaped and it'll be up online in about 24 hours after the conclusion of today's presentation. But next, I really want to take the time to, again, thank you, our donors, community leaders, and partners. You know the value of Journey Care. You've been with us, for some of you, for 40 years. Some of you have been part of our comprehensive campaigns of building our facilities. Some of you have been volunteers with our organization holding our patients' hands. You know the impact of Journey Care on the community and on family and friends. And for that, I am grateful and thankful for your partnership and your support. As we're heading into the holiday season, Thanksgiving is a few weeks away from today, and it's hard not to be able to be with family. Just think about our clinicians, our executive team members that are with our patients day in and day out. Our clinicians, our chaplains, our nurses are at the bedside of our patients. Many of them are neighbors, friends, and family members of our own. Think of them in your prayers. Think of them around your Thanksgiving table. It'll look different, but please know our staff will still be seeing patients and assisting our family members. So again, thank you for your support. And at this time, I'd like to turn it over to a board member of Journey Care Foundation, a friend to many of us, and a person that's been in the tax side of our country for probably the better part of 30 years, Mr. Howard Lappin. Howard, thank you.
Okay. Thank you, Joe. Good afternoon, everyone. I'm going to start the presentation by going through the current tax law, but that's going to be very quick because I want to spend most of the time on Joe Biden's tax proposals and show you what might be down the pike in a few months or in a couple of years. So if we look at current tax law, the first 4 or 5 slides are basically the current tax rates for 2020. They will increase a little bit. That is, the tax brackets will increase a little bit in 2021. And I wanted to put these in basically as a reference point. As you may remember, the Tax Cuts and Jobs Act that was effective in 2018 made several changes. This was probably the most important one, reducing the tax rates and going to 7 tax brackets. There were also some other changes. The standard deduction was increased, so many more people are taking the standard deduction versus itemizing. They also eliminated personal exemptions and put in a child care credit up to $2,000. One important thing that they did that was effective in 2018 is they set up this structure for capital gains and qualified dividends that you can see on the right side of the slide. So, for example, if you are an individual taxpayer, you're unmarried, and your income is less than $40,000 and you have capital gains, your capital gains will be taxed at 0. Between the $40,000 and $441,450, they'll be taxed at 15%. And then above the income amounts shown on the right-hand side of the table there, if you're above those amounts, your capital gains and your qualified dividends are taxed at a maximum rate of 20%. And this becomes important later when we talk about Joe Biden's tax proposals. I'm sorry, a couple of other changes. Let me go forward here. If you recall, state and local taxes were limited to $10,000. There were other changes relating to mortgage interest. The maximum was set at $1 million of mortgage indebtedness, basically. Most miscellaneous deductions were eliminated. And what I've told people during seminars is you can no longer deduct employee business expenses for the most part. And so if you have employee business expenses, what you want to do is go to your employer and try to talk them into reimbursing you, because those reimbursements, if done correctly, will be on a tax-free basis. Also, deductions for personal casualty losses are now only available if attributable to a federal disaster area. So there really has to be something like a hurricane or a tornado or flooding. Okay. Another important change affected estate and gift taxes. If you recall, we had a $5 million estate and gift tax exemption per person, doubled for married couples, and that $5 million was adjusted for inflation. That was increased to 11.58, actually 10 million is adjusted for inflation, and it's now up to 11.58 million, going to 11.7 million in 2021. However, this sunsets after 2025. In other words, it reverts back to 2017 levels if there are no further changes in the law. So in 2026, this would become approximately 6 million per person. So that's a big change. And I might mention, too, that basically the individual tax changes will also sunset in 2026. So the increases, or I should say the changes in the tax brackets, the increase in the standard deduction, all of those will go back to 2017 levels, except a corporate tax change, which we'll discuss in a little while. So let's go into the proposed tax changes. And first, let's look at President Trump's tax agenda. There really were no detailed provisions that were provided as to what Donald Trump would do in a second term. There were some vague statements that were made that there would be, for example, an unspecified tax cut. I've heard 10%, a reduction of the capital gains rates, but again, no numbers thrown out. Forgiveness of payroll deferral. Now, this is something that was done due to the COVID-19 pandemic. And what was done back in March is you were given the opportunity as an employer to have your employees payroll taxes of 6.2% paid by the employee and 6.2% paid by employers to support Social Security, given the opportunity to defer that into 2021. Then at the beginning of 2021, that would be paid back through payroll deductions. My understanding is very few employers took advantage of this, if you want to use the term advantage, because of the administrative complexities that would be involved and the fact that employees would have to pay this back, and they would be met with, in some cases, a nasty surprise in January because their paychecks all of a sudden would be lower. So very few did that. And Donald Trump has also said that he wanted to make permanent cuts to the payroll tax and fund Social Security out of general funds or through economic growth. You can make your own judgments as to how successful that would be. And then some things related to China and bringing back jobs and special tax breaks. Let's go into Joe Biden's proposals. And I do have some specific slides on some of these items. So one of the things he wants to do is raise the top tax rate. I'll talk about that in a couple of minutes. They want to raise the corporate tax rate, not all the way back to 35%, but up to 28%. They want to end the step up in basis. I'll talk about that, as well as the next item on capital gains. Limiting 1031 exchanges. Right now, real estate investors who own investment properties can exchange that investment property for like-kind investment property without any realizing any taxable gain. And like-kind property is interpreted very broadly. The government has looked at trying to end this tax break for many years, but the real estate lobby is very strong. So even if the Democrats end up controlling Congress, I don't know if this will go anywhere. The next item, applying the payroll tax to incomes over $400,000. Right now, if you're an employee, you pay 6.2% and basically payroll tax to support Social Security, but you only pay that up to a maximum. And this year, the maximum is $137,400, if I have that exact number correct. And it goes up next year to $142,000 plus. There's really not much you can do if they apply the payroll tax to incomes over $400,000 starting next year or the year after. There's no planning steps you can really take to address that situation. And the last change, 15% corporate minimum tax on book income over $100 million, because some large corporations, perhaps Amazon or Apple, pay almost next to nothing in corporate tax. They want to address that situation. Some other things that they want to do, they want to phase out itemized deductions, starting again for high earners, those with over $400,000 in income, as well as capping itemized deductions for those individuals at 28% of value. So in other words, if your mortgage interest deduction was $10,000 and you were making over $400,000, you'd only be able to deduct $2,800 of that $10,000. Reducing the estate tax exemption back to $3.5 million, which is the rate or the level in 2009, or I've seen in some proposals $5 million, again, as indexed. And we'll talk about that. Some good things in the proposals: new tax credits for some home buyers and renters, expanded child care credits, and I will talk about retirement savings incentives. So let's get into some specifics here. And the first one is that the Biden proposal would go back to 39.6% from the current top rate of 37%. However, note that this rate starts at $400,000, not the higher thresholds that are currently in place. So you would actually be moving some income from 35% to 39.6%. So it's a little higher of an impact than it might appear. The other thing we don't know is, how does that $400,000 apply to married couples? They've just said $400,000. Well, if you're married, does it double to $800,000? You know, under the current tax rates, it doubles at the lower levels, but as you get higher, it doesn't double. So we really don't know without a firm tax bill how that would work. Now, this is a big item. This is probably the biggest item in the proposal and also the toughest one to eliminate. Right now, inherited property gets a stepped-up basis. So in the example I have on the slide, John pays $40,000 rather for XYZ stock, a high-tech company, in 1995. And 25 years later, John dies, leaves the stock to his children. Under current law, that stock is being valued at $3 million, becomes the tax basis to the children. So if the children turn around and sell it for $3 million, there's no reportable gain. That gain of $2.9 million basically escapes taxation forever. And now, since Joe Biden wants to eliminate the stepped up in basis, and that $2.9 approximately $1 million becomes taxable, how's that going to work? Well, there might be some exclusions. In fact, when they tried this in 2010 and it lasted for a year as an optional rule, there was a step up of basis of 1.3 or 4.3 million, 4.3 million being for a spouse and 1.3 million being for others. So there could be that. But one major question in all of this is, will gains have to be realized upon death, or will it just be a carryover so that it doesn't get taxed to the children until they actually sell the stock? And that's really the $64 million question. So there's some major issues here. How will John's children be able to determine how much John paid for stock? You know, sometimes people are not very good record keepers, or you have stock where there's been mergers or stock splits. Also with real property. Maybe you have an uncle who 40 years ago purchased a farm and subsequently made improvements, didn't keep good records. And 40 years later, you have to determine the basis of that stock. How are you going to do that? And that's actually one of the major rules why we have a stepped up basis. I think Congress years ago realized, hey, in many cases, it's going to be tough to figure out someone's basis. Also, this could be a problem with the liquid assets or closely held businesses. Your parents and your grandparents worked for many, many years to build up a business. They built it up from scratch, and now it's worth millions and millions. If you're forced to recognize that gain upon death, how are you going to pay for that gain? You're going to have to sell the business, right? Or else you're going to have a heck of a lot of insurance to pay that capital gains tax. So that's a problem. And again, one ray of hope. There were two prior attempts to eliminate stepped-up basis. The one in 1976 was repealed before it even became effective. The one for 2010 was basically only effective for a year, and then Congress reached a compromise and put in some different rules. So these haven't survived in the past. It would be obviously an extremely unpopular rule, and so it remains to be seen how this will survive. Another big issue on capital gains and qualified dividends. Right now, I showed you the tax structure before. They're taxed at a minimum of 20%. For taxpayers making over $1 million a year, this would go up to 39.6% for the amount over $1 million for both capital gains and qualified dividends. Obviously, a major change. And with the 3.8% tax on net investment income and state income taxes, you could have a tax rate over 50% very easily. Our retirement plans, what they've proposed is replacing deductions with a credit. Right now, if you are in a 401k plan, you make a contribution to that plan every year. It's not included in your income. In effect, you're getting a deduction above the line for that amount that you contribute to your retirement plan if it's a 401k. Similar thing on an IRA. They would replace this with a credit. The amount of the credit is unknown, but 26% would be revenue neutral. If this goes in at that level, for example, it would be advantageous for taxpayers in brackets lower than 26%. The credit would be better than the deduction. But for higher earners, and that's brackets higher than 26%, the deduction would be worth more than the credit. So under this scenario, both Roth IRAs and Roth accounts in 401k plans and 403b plans become much more attractive. And it's a good planning device as it is, but they become even better. We'll talk about that in a couple of minutes. Reducing the estate tax exemption. Right now, as I mentioned before, it's going up to $11.67 million in 2021. Well, if it reverts back to 3.5 million or 5 million, and you have $1 million exemption for gift taxes with a top rate of 45%, you're going to have an issue for many estates that are currently exempt from estate tax. All of a sudden, they'd have an issue, and they would either end up paying estate taxes or at least have to plan to avoid estate taxes. Now, as I mentioned, that's going to sunset anyway in 2026. So some people have already started to plan for that. So what are some of the things you could do for, this is going backwards here. Okay. What are some of the factors that influence changes? Well, one certainly, and perhaps the most important one, is the control of the Senate. Right now, the Republicans control the Senate 50-48. The two seats in question are in Georgia. There's going to be a runoff election for those two seats on January 5th. Georgia has traditionally been a red state, in other words, Republican. However, that state has been changing and has been trending towards blue. And that's why they voted for President-elect Biden. Stacey Abrams back in 2018 almost became governor. So that's certainly a major issue, and I can't tell you who's going to win that election, but if the Democrats get both seats, they're going to control the Senate, and Vice President Harris would break any ties. Also, remember, in 2022, there will be 34 Republican seats up for re-election in the midterms, and 22 of those seats are Republican, 12 are Democratic. So there's certainly a possibility that the Senate could flip in 2022 if it doesn't flip this year. Other factors are COVID-19, the state of the economy, pushing through tax changes, if those are still in dire straits, might not work. And then the mix of progressive and moderate Democrats also come into play. So what are some of the things you can do as I wrap this up? Well, if your income is over $400,000, consider accelerating income into this year. Even if tax rates don't increase, that's not necessarily a bad strategy. Also, maybe accelerate deductions into 2020 due to the phase out and the 28% cap. That's kind of iffy because it's not really a good move if tax rates stay the same. Converting IRA to a Roth IRA. I think that's a good move, whether Joe Biden can control the Senate or not. And then always consider charitable donations of appreciated property. By doing that, you get rid of the capital gains tax. You no longer have to worry about that. You get a nice charitable deduction, which if you can't use in the current year, you can carry over for 5 years. Also, I don't know how many of you are familiar with the Secure Act, but the Stretch IRA, where you could stretch distributions for your beneficiaries over many, many years, has been reduced greatly. In some cases, in fact, in many cases, to 10 years. So if you're trying to leave it to a grandchild and stretch it over that grandchild's life expectancy, that in most cases is no longer doable. One answer to at least a partial solution to that is to set up a grant, a charitable remainder annuity trust, where you can pay an annuity to one of yourself or one of your beneficiaries, and then the remainder would go to the charity. You get all the tax advantages I just mentioned, and you're able to stretch that annuity, for example, for a grandchild over 20 years in many cases. So it's something to look at. If your income is over $1 million, then you want to look into accelerating capital gains into 2020. Maybe using installment sales where you spread out that capital gain over many years. Maybe look at investing in tax-free municipal bonds. I know the yields are very low, but being tax-free, that might be a partial answer. Again, the charitable remainder annuity trust or charitable lead annuity trust might help you find a solution to this capital gains issue. And also consider reducing reliance on dividend stocks. Now, estate planning considerations, again, if your estate is or will be over $3.5 million, consider accelerating your gift-giving strategy. A lot of people are already doing that in anticipation of 2026, but maybe look at doing a little bit quicker. Some other strategies, GRATs, charitable lead or remainder annuity trust. And by the way, in a low-interest environment, the charitable lead trust is a great device. It works really well when you do the math. So that might be something for some people to look at, where you actually pay an annuity to the charity and then take the remainder interest for yourself or your children. And then sales to intentionally defective grantor trust is another item. You might want to look at some of these. And some of these might be under legislative threat. They've been looked at before. And again, if the Democrats gain control of the Senate, some of these may be moderated or even disappear. If you're going to move for 2020, allow enough time to secure appraisals and do the necessary paperwork. It's already November 12th, and some of these things take time. Consider life insurance. You could have big liquidity issues on the capital gains issue or the estate issue, and it might be something to look at. Life insurance, that could be passed on, both tax-free and free of estate taxes, if done correctly. Sometimes you can couple that with a charitable remainder annuity trust. It's kind of a nice pairing there to replace the property that you give to the charity. And again, if the law forces gains to be taxed to death, You want to consider maybe gifting ahead of time to avoid a forced sale. That could be obviously a very significant issue for many families. Now, we're going to take questions. If I don't get to all of your questions, feel free to email me. I'll be glad to answer those within the next couple of days. And thank you very much.
Thank you, Howard. We do have a few questions, and I'm going to ask my colleague, Christine Post-Duncan, to join me now. The first question that I have, Christine, Howard talked a lot about different tools to use. If somebody wanted to use any of the tools that Howard had mentioned, how would they go about either enacting them or learning more about the apparatus themselves?
Sorry, Joe, could you repeat the question, Christine?
It's for Christine. I'm sorry, Howard.
So there's several ways to find out more about ways to use the charitable remainder trusts and charitable remainder annuity trusts that Howard had mentioned, or some other gifting ideas such as using appreciated assets. We have information on our Journey Care website under Leave a Legacy. We also have a group of, we call them our professional advisors tables. Howard's a member of that. They're a group of attorneys and accountants and financial planners that are familiar with Journey Care. Several of the people in that group have actually had family members who have been served by Journey Care, and they are available to talk with folks about different planning strategies they might have. I'm also available to talk with folks. A lot of times when people want to make a charitable gift, I'm usually one of the first people they would talk to about how to plan that out, because that's just what I do every day, and talk about different ways to look at that. And then they can take that information to their advisor, or I can work with them and their advisor to help implement some of those ideas for whatever works best for them.
Howard, one of the questions came up and you touched upon it a little bit. Most of the scenarios you gave did not identify joint or single. How should somebody go about, or the accountant that they work with, to make sure that when that is identified, the steps that they need to take to make sure that the joint and the single do benefit them on their tax filings?
Well, you definitely want to meet with your advisors. I would recommend that, even if you think that the Republicans are going to maintain control of the Senate. Remember, these individual tax changes sunset after 2025. Mm-hmm. So I would sit down with your accountant, sit down with your estate planner, and discuss the ideas that make sense to you at the end of the day. And I think that's how you handle that issue.
I'm going to go to the state side. There's been a lot of talk about raising the income tax, raising property tax, because of the vote that took place that was not passed this past election. Can you talk about any of the changes to Illinois tax code that you see that possibly be affecting people's filings?
Sure. So as you probably are aware, there was an amendment on the ballot to actually put in a progressive tax system in Illinois, and that failed by a fairly significant margin. And so right now the tax is basically 4.9%. They could certainly increase that in future years. They could also increase property taxes. And one thing is clear, you're not going to see state taxes go down, and probably not property taxes either. Now, one strategy that I didn't discuss that applies to state taxes is there was a Supreme Court case recently that involved a North Carolina trust. The trust was in North Carolina. The beneficiaries, the trust was in Delaware. The beneficiaries were in North Carolina. Delaware does not have a state income tax. So the trust took the position, hey, the trust on our accumulated income, we don't owe any tax because Delaware doesn't have a state income tax. North Carolina said, no, we don't care where the trust is domiciled. We care where the beneficiaries are. So we're going to tax the trust. The Supreme Court agreed with the trustee and said, no, you don't owe any tax on the trust. you would have distributed to the beneficiaries. The beneficiaries would then owe tax. So one strategy you might want to look at, if you're in a high income bracket, is establishing a trust in Delaware, Florida, Nevada, or some of these other states that don't have a state income tax. But you have to be careful. You want to make sure you're in the highest bracket, because the rates for trust kick into the highest marginal rate of 37% at around $13,000. So you don't want to push money into a higher federal bracket for the sake of saving money on your state income taxes. But if you're already in that 37% bracket, that may be a strategy you want to look at.
Okay. So Howard, you and I have spoken before. You've been a part of a few presidential transitions. How long do you anticipate upon Biden's inauguration day? When do you anticipate some of the meat to his proposals being flushed out? And how long do you think some of the debate will take from previous changes from a Republican to a Democratic administration?
Okay, so how long will this take? I mean, it's really, really difficult to say, because they couldn't even get the polls right the day before the election. So now, one thing to keep in mind that kind of ties into that question is, can tax changes be retroactive? So let's say that they finally get control of the pandemic, keep our fingers crossed, and everything kind of clears up, and they can put these tax changes, start to put these tax changes through a bill that's enacted next August. Can they make it retroactive to January 1st? Yes, absolutely. Some cases have challenged retroactivity on the grounds of due process. Those have gone nowhere. However, that's rare. The one time I could think of where they did make them retroactive was in 1993, where they went back to the beginning of 1993 under a bill passed around July, where they raised the tax rates and they changed some things. So it can be done. The Democrats are not favored to take Georgia. Understand that the Republicans are still favored. But, as we've seen, anything is possible. I think Trump was probably a clear favorite to take Georgia in the presidential election. So you really can't discount anything. But as I showed on my slides, there are some things you could do now, even if Biden's proposals never go through, that make a lot of sense, like maybe converting traditional IRAs to a Roth IRA. So if I were a betting person, I'd probably say it'll be a couple of years yet, but that's why I lose at the racetrack, and I'm not a betting person.
The last question we have is for Christine. Christine, you've worked with a good number of families. What is the one thing that a family should consider, of the type of information they should have before they start considering doing a trust? A charitable remainder trust, setting up their own family estate planning. What are some of the first things that they should have readily available, regardless of if it's a Republican or Democrat, you live in Illinois or you live in North Carolina? What are some of the questions, some of the documents people should have?
So the first thing you'd want to know is what are your plans? Have really clear in your mind what is the legacy that you want to leave. So is it important for you to leave all of your wealth to your children? Is it important to leave your wealth to charitable organizations? And if so, which one or ones? Do you have a top 3, a top 5? Do you want to do some combination of that? So having that clear in your mind as far as what you want your legacy to be would be the number one thing I would suggest people do. And then start looking at your list of assets. What seems like a lot of money for one person doesn't seem like a lot of money for someone else. So someone may have, they may think like, oh, well, I don't really have that much money. But then when you start looking at, oh, well, my life insurance is going to pay out $1 million or $500,000, and my house is worth, several $100,000. Oh, and then I have this retirement account. And then when you start adding all of that up, you realize, wow, there might be a much more significant sum that you'll be leaving behind than you realize. And again, what is that number going to look like? What's a good estimate of what that number is going to look like? And how would you like to distribute that? Things like what the current tax law is now will play a big difference, because if you're in that range between 3.5 million that Biden's talking about and the 11.5 million exemption rate that's currently in place, that strategy is going to look really different for how you leave those funds behind. So if you have a lot of stock or real estate that has a big capital gain, and there's no step up in basis in place, well, you want to make sure you have a plan for that now, or plan for that going forward. So it's really important to have those pieces together and know what's in place now and what's going to happen in the future, and make adjustments. There's all sorts of ways that you can meet both of those goals. Setting up charitable remainder trusts, for instance, that start now, or it can even start after someone dies. So it could be a testamentary trust where that capital gain property goes into a trust and pays out for 20 years to your children, and then at the end of that time, those funds can go to the charity of your choice. So there's just lots of different options to meet the goals you have. And so that's a very broad framework.
Howard, are there any questions or comments you want to mention before we conclude today's town hall?
I'm sorry, I couldn't hear you, Joe.
Are there any other comments that you want to make before we conclude?
No, just to remind people that it's really a good idea to have this review with your accountant and your estate planner if you're going to be running against those issues that I discussed.
Okay. Well, I want to thank Howard Lappin and Christine Post-Duncan for their time today. If you have any questions, feel free to reach out to the Journey Care Foundation. And I just want to once again thank our donors, our corporate partners, and community members. We are doing these town hall seminars for you. We are having these programs put on so that you have the information that positively impacts you and your family. And if you have any questions, please feel free to reach out to us. Again, happy Thanksgiving, and I look forward to seeing everyone very soon. Thank you on behalf of the Journey Care Foundation. Have a nice day.